All right, hello everyone. Good morning. So we are the group 5 and for today's discussion we are assigned to tackle about the lesson corporate governance. So the group we hope that you will be learning something from our discussion since we put our hearts and our efforts to produce this discussion. So let's now start. So the governance of enterprises has become a key concern in recent decades. Thus, it is broadly structured by the law, well, not just corporate law, but also environmental law, employment law, and so on. So governance is the system by which companies are being directed and controlled, accountability and transparency are assured. The purpose of corporate governance is to help an environment of trust, transparency, and accountability necessary for fostering long-term investment, financial stability, and business integrity, thereby supporting stronger growth and more inclusive societies. So in much more better understanding or in much simple explanation, governance is the system by which entities are directed and controlled. It is concerned with structure and processes for decision making, accountability and control, and behavior at the top of an entity. So, the most fundamental objective of corporate governance is to boost and maximize shareholder value and protect the interests of other stakeholders. So now let's define what is corporate governance. So according to an Organization for Economic and Cooperation and Development, they define corporate governance that involves a set of relationships between a company's management, its board, its shareholders, and other stakeholders. It also provides the structure through which the objectives of the company are set, and the means of attaining those objectives and monitoring performance are determined. So, corporate governance is a system that aims to instill policies and rules that helps maintain the cohesiveness of an organization. It exists to help hold a company accountable while helping them steer clear of financial, legal, and ethical pitfalls. So, in other words, it is therefore about what the board of a company does and how it sets the values of the company, and it also be distinguished from day to day operational management of the company by full time executives. So, for the next slide, are the importance of corporate governance. So first is governance and performance. So at an organizational level, the behavioral styles and business management practices of managers or directors can result in outcomes that are not in the best interest of shareholders and other stakeholders. These situations can range from relatively minor technical breaches of policies or practices to more serious cases where excessive risk-taking or poor controls place the ongoing survival of the organization at risk. So for governance and performance rather, with the emphasis on accountability embedded in popular definitions of governance, it is often forgotten that good governance is also the route to enhance performance. Governance allocates clear roles to the board and management, and a well constituted and high performance oriented board can motivate and encourage management to achieve greater corporate performance. So next, which is the second one, is accountants and effective governance. So as we all know, accounting as part of the overall governance process, it involves improving decision and making and achieving goals and objectives while maintaining and strengthening controls. One risk is that accountants spend too much time on governance and compliance based work and too little on enhancing business performance. Thus, it is important that as accountants, our focus combines both value creation and value protection. So, according to the International Federation of Accountants, or IFAC, recognizes that performance as part of governance is specifically related to value creation and resource allocation. The skills and knowledge and judgment of accountants in this area of decision making will be a crucial or significant, and the role of professional judgment is fundamental to achieving performance success.
Okay, so now let's discuss one of the corporate governance frameworks, and that is the shareholders. So, what is a shareholder and what are their roles? Shareholders are the persons or entities who own a company and have an important part to play in a corporate governance. They elect directors to operate the business on their behalf and therefore should hold them accountable for its success or failure. One needs to recognize that shareholders have delegated much authority to the directors, and that is the classic principal or agent relationships. There are different kinds of shareholders that are involved in dealing with companies. These shareholders are individual shareholders or institutional shareholders. These two will be discussed further, but before we dig deeper to the two, we must all remember that all shareholders do not have the same need or opportunity to participate in the governance of the company. In fact, as the company is a separate legal entity, the powers of shareholders are often clearly defined in laws and limited to certain decisions, including first, changes in a company's institution; second, the appointment and removal of directors and auditors; and lastly, the approval of directors' remuneration. These issues that concern each group of shareholders will vary and depend. Like, for example, on the number of shares they hold, the length of time their shares will be held, and the level of interest demonstrated by the shareholders. Despite varying levels of need and opportunity, shareholders in general do have similar rights and obligations. Shareholders who hold a significant stake in a company are often able to use their voting power to gain places for themselves or their nominees on board. In principle, or in the Code of Corporate Governance, these nominee directors are supposed to act in the interests of the company, not in the interests of the major shareholders, in which the company should be headed by a competent working board to foster the long-term success of the corporation and to sustain its competitiveness and profitability in a manner consistent with its corporate objectives and the long-term best interests of its shareholders and other stakeholders. However, in practice, there is a risk of decisions being made that favor major shareholders at the expense of the minority. If any shareholder has a controlling shareholding, then it may be possible for them to use their voting power to create a board that is unbalanced. And with this, boards should be balanced and demonstrate substantial independence in their compositions. Okay, so let's go back to the two different kinds of shareholders and let me focus on the individual shareholders. So, what is an individual shareholder? So, individual shareholder are the shareholder that is not an institutional investor and who is not a party to the employee shareholders' agreement. Individual shareholders want companies to be run efficiently and profitably, and for the companies to be adequately supervised by the board. They also want honesty from directors and managers. To achieve these objectives, shareholders are prepared to be more vocal. The media and the internet have provided vehicles and shareholders to more publicly express their concerns regarding poor corporate governance practices.
Now let's proceed to institutional shareholders. An institutional shareholder is a legal entity that accumulates the funds of numerous investors, which may be private investors or other legal entities, to invest in various financial instruments and profit from the process. In other words, an institutional shareholder is an organization that invests on behalf of its members. The characteristics of institutional shareholders are the following. It is always a legal entity, and it is important to understand that an institutional investor is an enterprise managing a fund, and the basis of an institutional investor's activity is professional, and it manages assets based on the interest and goals of its clients. It also manages a significant number of funds. Unlike individual investors who buy stocks in publicly traded companies on the stock exchange, institutional investors purchase stock in hedge funds, pension funds, mutual funds, and insurance companies. They also make substantial investment in the companies, very often reaching millions in dollars in value. The institutional investor is not the beneficiary of the earnings from the investment, but the company as a whole acts as beneficiary. So here are the different types of institutional shareholders: the insurance companies, the mutual funds, the hedge funds, and the pension funds. Insurance companies are heavyweight institutional investors. These are institutions employ the premium they receive from policyholders into securities. Since the aggregate of premium is considerable, their investments are also sizable. The returns insurance companies receive from trading are deployed to pay for claims. The mutual funds are vehicles facilitating investment in a variety of securities with capital commitment from several investors, both individual and institutional. In other words, numerous entities invest their capital, which is pooled and in turn invested in a bag of securities called mutual funds. On the other hand, the hedge funds is another popular instrument in line with institutional investors. It can be best described as an investment partnership where the money collected from members is pooled to invest in securities. Pension funds are also a popular form of institutional investors. Both an employer and an employee can invest in pension funds. The accumulated capital goes toward the purchase of different kinds of securities. So, institutional shareholders are considered sophisticated investors who are knowledgeable and therefore less likely to make an informed decision making and investments. As a result, institutional investors are subject to fewer of the protective regulations that the Securities and Exchange Commission provides to individual investors. They also have an enormous amount of pooled money that belongs to the companies and organization for which it invests. Because of their size, plus the size and the volume of their investments, institutional investors can often negotiate better fees associated with their investments. They also have the ability to gain access to investments normal investors do not, such as investment opportunities with large minimum buy-ins. However, an institutional investor can either invest on behalf of others or in their own capacity. If they invested using their account, then they would not be considered an institutional investor. While some people own their shares, others own them through institutional investors who invest their money in other savings or investments accounts. For example, a portion of many people's paychecks is given to a pension fund each month. The pension fund uses the money to buy other financial assets to earn a profit. In this case, the pension fund is an It's an institutional investor as they are buying shares on behalf of the people who invested their money in the fund. Since institutional investors buy securities and financial assets at a much greater scale than their retail counterparts, they often exert a significant influence over the financial markets and the economies of nations. They are also a major source of capital for companies that are publicly listed on the stock exchange. So, institutional shareholders is a vital portion of financial markets. Thus, they're often cited as market makers. They trade in large volumes because of the number of investors involved. Moreover, institutional investors seldom commit their own capital, but instead make investment decisions for their members.
Hello, I am Hannah and I will be discussing the board. The board and directors are the most significant components of corporate governance. The board or a board of directors is the governing body of a company elected by shareholders in case of public companies to set strategies and oversee management. The board of directors are composed of a chair, executive directors, usually including the CEO, and non executive directors, some or all of whom may be independent. Each board must have a chair. The role of the chair is to lead the board of directors, including determining the board's agenda, obtaining contribution from other board members as part of the board's deliberation, and monitoring and assessing the performance of the director. His role is very crucial to ensure that the board works effectively. In some countries, the chair must be independent, for example, the UK. Other countries do not consider chair being independent as critical, like in the United States. Now let's know the functions and responsibility of the board. Presented on the screen is the Tricker model. This model shows the function of the board and that are monitoring and supervising, providing accountability, strategy formulation, and policy making. In monitoring and supervising, the responsibilities of the board is to take steps designated to protect the company's financial position and its ability to meet the debt and other obligations. It is also the responsibility to adopt an annual budget for the financial performance of the company and monitor its result. And lastly, to ensure the systems are in place that facilitate the effective monitoring and management of the principal risks to which the company is exposed. The responsibility of the board is providing accountability is to determine that the company has instituted adequate reporting system and internal controls, to determine that the company accounts conform with accounting standards, to determine the satisfactory arrangements are in place for auditing the company's financial affairs and the scope of external audit is adequate, selecting and recommending auditors to shareholders and general meeting, and lastly, ensuring that the company has in place a policy that enables it to communicate effectively with shareholders, other stakeholders, and the public generally. In strategy formulation, the responsibility is determining the company's vision and mission, reviewing opportunities and threats, strengths and weaknesses, considering and assessing strategic options, and adopting a strategic plan for the company. The responsibility of the board in policymaking is to establish and monitor policies directed at ensuring that the company complies with the law and conforms with the highest standards of financial and ethical behavior. Selecting and, if necessary, replacing the CEO, setting an appropriate remuneration package for the CEO, ensuring adequate succession plans are in place for the CEO, and giving guidance on the appointment and remuneration of other senior management positions. Adapting formal processes for the selection of new directors and recommending them for the consideration of shareholders at general meetings, reviewing the board owned processes and effectiveness and the balanced competence of the board, approving and working with and through the CEO, adapting clearly defined delegations of authority from the board to the chief executive officers, and lastly, agreeing on performance indicators with management. Next is the committee of the board. The effectiveness of board and the particularly of non-executive director is likely to be enhanced by the establishment of appropriate board subcommittee, usually simply referred as committees. These committees enable the distribution of workload to allow more detailed consideration to be given to important matters such as executive remuneration and external financial reporting period. Subcommittees are important for creating environments where independent director views can take priority in order to achieve independent decision. Here are the committees that are required by the various corporate governance. In case of and these are Nomination Committee, Remuneration Committee, Audit Committee, and Risk Management Committee. Nomination Committee is primarily responsible for recommending the succession procedure within an organization. Succession is the concept of identifying and selecting people who will replace senior staff when they leave. An important aspect of succession responsibilities is recommending candidates for shareholders to vote on the board of directors. Remuneration Committee sets the company's remuneration policy, determine each executive director's total individual remuneration package, and set targets for performance-related pay. Important aspects of remuneration include what and how directors and executives are paid. The Audit Committee is in many ways the most important in relation to the conformance aspect of corporate governance. It is often considered the appropriate conduit between the company and the external auditor, ensuring that the work of external auditors maintains the integrity and independence. The Audit Committee provides oversight of the financial reporting process, the audit process, the company system external controls and compliance with laws and regulation. To ensure that independence of Audit Committee, it is recommended that Audit Committee comprise only non-executive members, with the majority being independent and Audit Committee with no executive means that communication with the external auditor at a formal level will take place without the CFO. This is an important aspect of good governance at the auditing reporting phase. The Risk Management Committee shall evaluate the significant risk exposure of the company and assess the management actions to mitigate the exposure in timely manner, including one-off initiatives and ongoing activity such as business continuity planning and disaster recovery planning and testing. Risk management is important to ensure that risk is assessed, understood, and appropriately managed. This is important for both for conformance and performance. It is essential that strategic planning and management decisions are made appropriately in the context of the risk appetite of the corporation and its various stakeholders, especially its shareholders.
Okay, let's proceed with auditors. Most large organizations have an internal audit department which generally reports directly to the audit committee. Internal auditors undertake a variety of tasks that contribute to good corporate governance. In general, the internal auditor plays an important role in ensuring that internal financial controls, compliance controls, operational controls, and risk management systems are operating effectively. The external audit is also a vital part of the governance process. Investors rely heavily on information provided in financial reports. It is essential that these reports are accurate and free from material misstatement. Accordingly, the capacity of external auditors to conduct a thorough and independent review of the financial statements is the cornerstone of the corporate governance process. Audit failure is the term used when an audit is deficient due to negligence, incompetence, or a lack of independence by the auditor. While the vast majority of audits are conducted in a satisfactory manner, regrettably, and there are exceptions. The external auditor, as an independent party with a detailed knowledge of the entity's financial affairs, is able to provide substantial advice to the audit committee. The external auditor may also assist the audit committee by informing it of any developments, such as legislative changes or new accounting standards. It is also important that the external auditor should attend the full board meeting when the financial statements are approved to enable all directors to ask any questions they may have regarding the financial statements or the audit process. So that would be all for auditors in corporate governance.
Regulators. Regulators have an important and increasingly complex role in the delivery of regulatory regimes and regulations. The governance arrangements for regulators are a key factor in a regulator's ability to operate effectively to achieve social, environmental, and economic outcomes it is responsible for. It ensures that there is a basis for an effective corporate governance. As the nature of financial services continues to evolve, adherence in high ethical policy and operational standards by those who operate in the sector is imperative to ensuring stability and growth. Regulators within the financial services industry and the securities in particular have responsibility for ensuring that the appropriate regime, standards, and practices are developed and applied in relation to corporate governance principles. This is really speaking to the effect of standard setting, policies relating to the governance and conduct of business, reflecting principles that promote transparent and fair markets and are consistent with the rule of law to support effective supervision and enforcement. The community is confident that market corporations and businesses involved in them and can operate efficiently and honestly to contribute to improving economic performance. Companies can get on with doing business confident that the same rules are applied to everyone. They can seek capital in markets at the rates that are broadly competitive with leading world markets and without paying a significant market risk premium. Financial markets are well respected and attractive internationally and clean, fair, and reliable. Everybody can find and understand their obligations. It hones on the need for realistic guidelines that serve the needs of all participants in the industry, including both institutional and retail investors. Investors and consumers participate confidently in our financial system using reliable and trustworthy information to make decisions with ready access to suitable remedies if things go wrong. The right of stakeholders should be properly established in business, insolvency, and contract laws. The framework should speak to agreements between public issuers and their stakeholders and should make provision for lines of readiness for stakeholders. There exist aspects of legislation which speak to core corporate governance. However, there still remains a call for regulators to develop legislation that speaks directly to corporate governance and what is expected in the various sections of the financial services industry. In the developing business industry, it is important that there is consistency among regulations to avoid legal conflicts and over-regulations. And by doing so, we are hoping to develop an environment where good businesses can thrive and shareholder value can be protected.
The next topic is all about stakeholders. The term stakeholder is used in a very broad sense, meaning anyone who is affected by the operations of an entity. These stakeholders include not just shareholders for corporate entities, but also parties such as employees, competitors, customers and suppliers, lenders, society generally, and indeed, even the environment. Stakeholders are parties invested in the success of a business or organization. Many decisions and results need to be considered from the perspective of various stakeholders to ensure all investments are honored. Every organization or business has stakeholders. There are different types of stakeholders having a stake or interest in the business. They work for the business or organization success. So, what are stakeholders in business? Stakeholders are parties that take interest in a specific company, often for financial investment. They can directly impact decisions or successes of an organization through sharing their feedback on company decisions or processes, providing continued loyalty or participation, increasing or decreasing financial investment, and taking a position or making a decision that goes against a company's goal and strategy. The next one is about stakeholder concept. In this slide, the Anglo-American corporation law approach was highlighted as it says that director must act in the best interest of the corporation as a whole. This means corporations are run according to the corporate law duties in relation to shareholders. However, this approach does not mean that a corporation should be run for the exclusive benefit of its shareholders. Any director or senior manager who believes that acting according to this approach will lead to long-term success and satisfactory corporate governance is mistaken. The success of an organization depends on the successful management of all the relationships an organization has with its stakeholders. The principal focus of our discussion in this module is on the Anglo-American derivative duties approach to stakeholders. Stakeholder theory is considered further in Module 5 as part of the discussion of sustainability and social responsibility concerns. Next is stakeholder map. In this slide, there is figure 3.4 for corporate stakeholders. There is corporation in the middle and it is surrounded by parties including environment, agents, owners, suppliers or lenders, consumers, competitors, auditors, employees, regulators, government, and community. Stakeholders differ across organizations. Figure 3.4 provides a diagram of potential stakeholders that may be of concern to an organization. In any situation, some stakeholders will be more important than others to a particular corporation at a particular time, and inevitably, this stakeholder map may omit relevant stakeholders. You should observe that stakeholders are not only people or corporate entities, but even the environment is a stakeholder, as the corporation's operations may have an effect on it. Notice also that competitors are treated as stakeholders because there must be a commitment to open and fair competition in the marketplace. And if a competitor undermines this, both producers and consumers suffer. Those affected by a particular corporation are stakeholders of that corporation. Where a stakeholder's interest is significant, corporations must manage the relationship carefully.
And now let's proceed to the nature of the corporation and some stakeholders' relationship. The table shown is there is the stakeholder, relationship, type and source of power, interests and influence, and also the risk. The stakeholder number one is the investors. Its relationship, owners who are a source of finance in the form of equity. The type and source of power is legal power through the Corporations Act, political power through institutional investors, and voting power at general meetings. The interest and influence of the investor is return on investment, satisfaction from ownership interests. Investors can withdraw finance if they are dissatisfied with the company's processes. The risk is underperformance may mean withdrawal of investment or investors' pressure to remove director. Second is the customers. The relationship is purchasers of good or services. It is political power through word of mouth, media, and social media. Economic power by spending elsewhere. legal power through the Competition and Consumer Act and the ACCC. The interest and influence is satisfaction with value from purchase. Dissatisfaction can lead to customers not wanting to buy services, and it may lead to negative publicity by word of mouth or social media. The risk of the customers is reputation risk management will be needed if customers receive poor service or faulty products. Third is the supplier. Supply goods or services. The type and source of power is economic power by restricting supply, legal power through the Competitors and Consumer Act and the ACCC. The interest and influence is revenue from sales, business relationship. Poor experiences with a company may lead to a refusal by a supplier to deal with the company. Risk, the directors may need to source other products from other suppliers if the company fails to pay the supplier for goods or services. Faulty goods or services received from a supplier may also lead to the company's reputation being damaged. The fourth is the lenders. Its relationship is supply funds. The type and source of power is voting power by having a director on the board. Economic power by lending terms and conditions of the lending contract. Um, the interest and influence of lenders is revenues from interest, and lenders may choose not to lend depending on the credit rating of an entity. The risk is finance may be unobtainable if the company cannot pay back the principal plus interest. Fifth is the employees. The relationship is to provide labor. Uh, type and source of power is political power by withdrawal of labor, legal power through the Fair Work, Disability and Discrimination and Work Health and Safety Acts. Interest and influence of the employees is salaries and wages, job security, important life activity. Employees can withdraw labor if conditions and workplace get worse. The risk is poor management of employees can lead the board to see evidence of employees turnover. Misconduct by employees may lead the organizations to suffer reputational damage. Next is the government. Its relationship is to receive taxes, impose regulations, provide general infrastructure. The type and source of power of government is legal and political power through acts of parliament, economic power through the taxation system. The interest and influence of government is are the source of revenue, society interest, economy, legal compliance. Government may choose to impose greater regulation on a sector if specific companies are perceived to be misbehaving. The risk would be boards may find an increase in regulatory risks that arise from new laws and regulations. Also, threat of regulatory enforcement directed at boards where they or responsible staff fail to comply. Lastly is the society. The relationship of society is to consume goods or services, provide standard operating practices, legal and social permissions. The type and source of power of the society is political power by influencing politicians and social media, and economic power through spending elsewhere. The interest and influence of society is good corporate citizen, positive impact on society. Poor behavior from a company can lead to an industry being ostracized by the community. Lobbying may exist to shut down or prevent an industry from starting up or expanding. Lastly, the risk of the society is directors may bear the consequences for poor decisions made in relation to services offered, goods sold, and the company attitude towards the corporate social responsibility. In addition to the problem of identifying significant stakeholders, other issues arise from stakeholder theory, including the following. First, how should managers allocate or prioritize limited time, energy, and other resources among stakeholders, and according to what time frame? Balancing the interests of stakeholders is obviously an important aspect of corporate success, and the best boards and managers do this well and will enjoy success accordingly. Second, some argue that stakeholders theory places too much discretion with management. They contend that stakeholder theory is too vague. For example, management could claim to be balancing the interests of various stakeholders while in fact acting to further their own interests. Generally, self-interest is not a bad motivator, but it must not be at the expense of stakeholders. Next is critics of theory decry the infringement of property rights of the owner of the corporation. For example, free market supporters have taken the approach of Milton Friedman and argued that stakeholders other than shareholders should not form part of management thinking. Lastly, some consider that under stakeholder management, there is potential for stakeholder to be co-opted, captured, and controlled. Talking about employees, these are the important stakeholders in any corporate environment. In increasing knowledge-based businesses, it is the knowledge and skill of employees, including managers, that will be critical to the success of the company. In this sense, the employees become the greatest asset, example in professional service firms, and without this asset, the company cannot compete. In some jurisdictions where dual board structure exists, example Germany, employees may have a more formal role on boards, especially on the lower tier board. It is not uncommon for very senior managers also to be on boards. For example, the CFO may well join the CEO on the board and will therefore also possess the joint characteristic of being an executive and a director, and have the complex mix of two sets of duties. Importantly, in all jurisdictions, managers and employees alike are owed duties by corporations and, in turn, owe duties to the corporation. For example, employees are entitled to safe working conditions and holiday periods, while employers are entitled to expect diligent service and protections such as confidentiality about commercially sensitive information. We have previously emphasized the importance of all stakeholders and addressed issues relating to various stakeholders. The significance of customers in the value chain is obvious, and much emphasis has been given to the economy, to competitors, and to consumers or customers. Suppliers and lenders, although upstream in business relationship, are also very important stakeholders. Developing and maintaining good relationships with suppliers and lenders will improve performance, example, ensuring legal compliance and correct ethical relationships. On the performance side, good relationships add value by avoiding disruptions and reducing transaction costs and cost borrowing through lower interest rates if lenders better understand a borrower. In fact, often businesses are more immediately dependent on the goodwill of their suppliers and lenders for their continuing success on a day to day basis than on their shareholder with whom may have more distant relationship which only becomes focused
more sharply at the time of reporting the annual result. It is important to appreciate that just as a business will wish to have dealings with ethical lenders and suppliers based on well understood relationships, lenders and suppliers will have same expectations in return. Good relationship will make it easier to conduct business and will reduce overall cost. The table shown provides a basic list of important matters to consider in regard to suppliers and lenders as stakeholders of a corporation. Considering suppliers and lenders as stakeholders. First is the supplier. The areas for consideration is first, reliability and on-time performance. Second is quality at delivery. Third is terms for payment, including timing and discount. Fourth is financial security and alternative suppliers. Fifth is refund and warranty policies for good acquired. Sixth is willingness to work in partnership within the law. And lastly, compatibility of ethical standards and codes of conduct. Second stakeholder is the lender, and the areas for consideration is security required, significant debt covenants involved, interest rate applicable, fixed or variable, upfront fees, rollover fees, and ongoing charges, principal and interest repayment timing and costs, and lastly, special purpose financial reports or information. Next is I will be going to talk about the consumers or customers. Consumers or customers are very important stakeholders. Corporations recognize that the long-term support from consumers for their outputs will be important for value generations and corporate performance. However, many managers and corporations succumb to the temptation to seek quick profits without proper care for consumers and their long-term needs. Sometimes there are even deliberate attempts to target vulnerable consumers by deception and dishonesty. For many businesses, the relationship with customers is changing. Rather than the customer is being the passive purchaser of a good or service, the customer's views and ideas are actively canvassed as a means of product and performance improvement. This can serve to deepen the relationship with customers, and in some instances, customers become more active collaborators in the design of products and services. This form of active customer intelligence and involvement is what is required in rapidly changing markets with constant innovation. So, next reporter, please.
On this slide, we will tackle about management. One purpose of corporate governance is to implement a checks and balances system that minimize conflicts of interest. Conflicts typically arise when two involved parties have opposing opinions on the way the business should be conducted. So, here are some roles and responsibilities to minimize conflicts. Managers are the agents of the board. They are responsible for pursuing the vision of the company as developed by the board and fulfilling the strategic direction determined by the board. Next, management's responsibilities include strategic planning, risk management, and financial reporting. The CEO are responsible for setting, managing, advance strategic direction, and establish the policy and values of the company. Lastly, CEO's responsibility to run the operations of the company under the oversight of the board and keeping the board informed of the status of the company's operation. Though there are still some instances in reality, the interface of governance and management is more complicated. Mostly, board and managers understand their different roles, but sometimes there are things that are out of hand. For example, in the choice of strategy. the rapidly changing markets and technology lead the boards to be continuously engaged in strategic decision, but the managers they feel that the board is becoming more involved in the implementation of strategy when it is their work. On the other hand, some instances the board may feel that the managers are making significant decisions without the approval of the board. Next slide, operational management. Boards of directors are often highly skilled at financial analysis and strategic thinking and policy development. But it is the role of the manager to implement all of these characteristics. It is the management who inspire employees with the goals of the enterprise, delight the customers with the quality of the product and services, convince suppliers and distributors that the company deserves their full support, and lastly, keep stakeholders on side. The ultimate role of the CEO is ensuring that there is energetic commitment of managers to their task of realizing the vision of the board and making success of the company. An effective management team runs the company with a focus and executing the company's strategy over a meaningful time horizon, and they avoid an undue emphasis on short-term metrics. Effective corporate governance requires dedicated focus on the part of directors, the CEO, and senior management to their own responsibilities and together with the corporation's shareholders to share goal of building long-term value.
Okay, that would be all for our group, the corporate governance. We hope you have learned something from us. Thank you so much for listening.